The JMF Advisors Show is a podcast for business owners, C-suite executives, and entrepreneurs who are looking to build, grow, or even exit a business.
We bring in some of our best financial advisors to interview experts on business best practices, hot topics, and sprinkle in some tax and accounting help.
If you're a business owner, startup founder, CFO, or just starting your side hustle, this podcast is for you.
Hi, and welcome to the JMF Advisors Show. My name is Katie Grissom. I'm a manager and CPA on the tax side at JMF, and I'm joined today by Dave Berney.
Hey, I'm Dave Berney. I am a wealth advisor at JMF Capstone Wealth Management, so the wealth management side of the firm.
Yeah, so today we're going to be talking a little bit about retirement planning for the millennial generation, and so that's going to include a lot of kind of general retirement type tips, planning tips, but also, for the millennial group, those are folks that are between 28 and 43 years old at the moment. And Dave and I, we've figured out we're both 34 years old, so we are squarely in that group.
That's right.
This whole group, though, they're in very different places in life. They're just different situations across the whole generation, of course, especially when you have that large of an age group. Some of the things that kind of hold true that might be relevant to retirement planning are that this group has higher rates of college than previous generations, might have more student debt, possibly higher average income across their careers, but then also they might be more likely to change jobs more often, which could kind of complicate retirement planning, might be more accounts to take into account. But so that's kind of what we're looking at today. And we'll start, Dave works with, of course, a lot of clients, prospective clients. So Dave, what are you looking for when you start that discussion with a client about retirement planning?
Perfect segue. So really, no matter where they are, millennial or not, what we're trying to do when we do planning is get to know the individual person. We do life planning. That allows for financial planning and advanced planning. But if we focus on the start and speak in generalities, when you're getting started, what you don't want to do is put yourself in a position where you're having to withdraw retirement funds early. It's important to start early, not to overdo it. You want to create a plan that you'll stick to. So what we talk to people about is there's a hierarchy of savings vehicles. And, a lot of the questions that we get is how and when should I contribute to a retirement plan? And the answer is as soon as possible. But going back to, not having to withdraw retirement funds early, really what we recommend is, if you have a baseline monthly budget, you really want to have 3 to 6 months of emergency savings because life it happens. You may lose a job, you may have to move, you just don't know what can come up in life, but you don't want to, again, be so strapped for cash that you would have to withdraw retirement funds early. So beyond having that, 3 to 6 months of emergency savings, what's crucially important if you are an employee and there's an employer retirement plan, whether it be a 401k, 403b, oftentimes the company is going to offer a match, which is a dollar for dollar contribution. So, let's say it's 3%. If you put in 3%, the company will put in 3%. There's all sorts of structures, but in that instance, the next most important thing is to at least contribute enough to get that company match. Because that is a 100% return. The company's matching you dollar for dollar. Mm-hmm. I can't say that, but yes. So, after that company match, let's say your income's higher, you're able to contribute more, or your costs are low, right? Because you're starting out and you don't have high costs because you don't have a family or something like that, right? Then, if you have an HSA that's available to you, that's a great pre-tax opportunity to contribute to, potential health events that come up or even just routine maintenance, right? Whether you're just seeing the doctor or the dentist. So it's great to contribute to an HSA. Depending on your income, and we'll go into this more later, but it could make sense to contribute to your own Roth IRA, and we'll talk about the difference between Roth and traditional IRA. And if you can max that out, which is $7,000 this year, if you can max that out, then start going back to that employer retirement plan, right? So we talked about at least get the match. You can contribute up to I believe it's $23,000 this year, 2024, into an employer retirement plan. Get the match first. You'll probably have more options available in an individual, IRA or Roth IRA. Then go back to that company retirement plan. And rules of thumb absolutely do not work in financial planning, but some of the basics are definitely more applicable when you're looking at, folks getting started.
Mm-hmm. And of course, we were thinking about that of course is kind of the ideal scenario. We talked briefly about student debt earlier, how that might apply to millennials, obviously mortgages, whatever other kind of debt may be there. So just want to say that obviously debt obligations are also going to play into kind of this hierarchy of what you should be paying on.
100%.
And that's, kind of a very personal decision as to where money goes, obviously. But some of that, of course, depends on interest rates and how much you can get in the market versus how much your interest rate is on your debt. So, of course, that plays into it. But because that is so personal, we're not necessarily going to delve into that very deep here. So, when we're doing this, when we're contributing to these retirement accounts, I think the biggest question it seems like a lot of people have is kind of what is the difference between Roth and just kind of a normal tax deferred retirement plan. And so when it comes to that, it's really, I think the words that Dave used were pay now versus paying later. When are you paying taxes on these funds? And at the basic level, that Roth account is something that you are paying taxes on now. The contributions come from after-tax funds, so you don't get a current tax deduction for that. But then later on, when you take it out, those distributions, including whatever earnings you have, investment earnings, are going to be tax-free. So then your traditional type tax-deferred accounts are going to be the opposite of that, in that generally, pending, AGI limitations and everything like that, generally you're going to get a deduction now, a tax benefit now, and later on when you take it out, you'll be taxed. So it's kind of this guessing game, really, when you're trying to determine which of these that you want to contribute to or how much to each one. And we were saying, of course, it's not an exact science. It's very hard to, it's a guessing game to figure out what your tax bracket, your tax rate is going to be when you are in retirement, and what obviously the whole income picture looks like at that point. And then also how that compares to your current situation. So ideally, you would be using your tax deductible contributions in a higher tax bracket, so that you would be able to get that benefit now and then pay tax when you're in a lower bracket. But so all that aside, sometimes that can just really depend on things, just your personal cash flow needs at a certain time. So I was saying that when I was, contributing to our employer plan, at some point I switched from Roth contributions to traditional 401k contributions, and that was just because we had daycare to pay for.
Yeah.
So a lot of that, obviously, when I switched from Roth to a traditional contribution, we got more of a tax deduction then, and so that was helpful then when we needed that.
I think that's exactly it. It's a cash flow question. I don't have a crystal ball. If I had to take a guess, I would guess that maybe tax rates go up. They're at some of the lowest that they've ever been. But one thing I do hear a lot on the wealth management side is exactly what you said, where maybe I'll be at a lower tax bracket when I'm retired. And that can certainly be the case more often than not. And this is purely anecdotal, but what I see is that's not the case because of people are simply keeping up their same lifestyle when they retire. And the first 2 years of retirement typically are the most expensive because you're doing all the things that you couldn't do when you were working. But, that's not the case if you're withdrawing funds from a Roth IRA because you don't have that tax obligation on those funds. So traditional IRA, if it makes sense for your cash flow, that's wonderful. Makes perfect sense. It is a cash flow question. Just know that, the government does have a claim to some of that money.
Absolutely. And one thing I've heard too is for many people, it makes sense to have a mix of both anyway, just so when you do reach retirement, there are some options there if year over year things start to look different.
That's absolutely true. So, there are different tax laws associated with different accounts, and we were talking about Roth IRA and traditional IRA. There's also taxable accounts, and without going into all of the differences, it's really helpful from a tax planning perspective or retirement planning perspective when people have funds in various types of accounts. It's a lot more complicated, and this is where planning is really important, when you start actually withdrawing money from various accounts and you find the most efficient way to do it than when you're actually contributing to those accounts. So to answer the question succinctly, yes, it's great to have both.
Well, and of course, these are, so those two characteristics, there are, like we said, there are Roth IRAs, there are traditional IRAs, there are Roth 401ks if your employer offers that versus just a regular IRA. Then when it comes to self-employed people, there are some other options outside of a 401k that could make sense for those type of individuals, freelancers, people like that.
Absolutely. And one thing that I'll touch on really quickly with the Roth 401k is those are not subject to income limits where just a traditional Roth IRA is. So no income limit on a Roth 401k from your employer. But as Katie mentioned, what I've come across in a lot of conversations with folks who, let's say they're sole proprietors and high income earners, it's really from an administrative side, it can be expensive to roll out a full-blown 401k. And most people hear 401k and they hear retirement plan, but it's not the only one, especially not for a sole proprietor. So there's something called a simple IRA, which can make a lot of sense for a sole proprietor or for a business owner. The conversation around company retirement plans is usually dictated by how consistent is your income, how much money do you think that you can realistically contribute to it each year. And sometimes that conversation happens in coordination with the individual, their CPA, and wealth management. It's really easy when all parties can kind of be party to the conversation. But a simple IRA, as of 2024, there's a $16,000 per year limit on contributions. If you're over age 50, it's $19,500. Plus, there's a 3% company match. So that's a business write-off to you if you do operate that business. Now, there's rules on exclusions, and you can choose who gets to participate if you operate a business with employees. But you do have to contribute to those employees' accounts as well, and it's their money from day one in the simple IRA.
There are SEP IRAs, which are employer-only contributions with higher contribution limits, which are $69,000 in 2024.
And finally, if you're a very high earner, or just have the ability to put a lot of money away, and so an example of folks who I've set solo 401ks for would be like a CRNA or a doctor or somebody who, has a business of their own, but maybe operates within a hospital or something like that. And that's just one example, but you can have a solo 401k and it's going to be higher contribution limits. So you do get the $23,000 elective deferral as an employee, and as an employer, you can put up to 25% of your compensation in there as well, to a total maximum of $69,000 per year. So that's a great way to contribute a lot of pre-tax dollars if that's the position that you're in. Or if you'd rather, contribute on the Roth side, there are Roth solo 401ks as well.
So it pays to be aware if you're a business owner, whether you yourself are the only worker in your business, or you have employees outside yourself, that there are these options that are available outside of just IRAs that can allow you to put away more money for retirement, and usually that would be based on the income that you have in any given year.
Yep.
So that's helpful when obviously your business income is inconsistent, possibly from year to year. So and kind of along those lines, we talked about basically if you have an employer plan versus if you are the employer yourself or you're self-employed. There's also, if we talked a little bit about how as a wealth manager, Dave he goes in with the goal of long-term planning. Yep. And of course, as CPAs, we would love to also be able to do that. Sometimes sometimes that is not necessarily our client's goal as well. And so, sometimes we fall into a compliance type mindset, but with that never being the goal, long term always being the goal. But one option too that we have that is kind of on an annual, looking at it just 1 year, would be, if you get to the end of the year and you owe taxes, it may be, depending on your income in that year, your AGI in that year, that you can contribute some to a traditional IRA to have that tax deduction and lower your taxes due, kind of shift some of that income from paying income taxes to actually contributing to your retirement if you have the funds available. But so that's something that can be done at the time the tax return is filed. So it could be done in April, for instance, for the prior tax year. So that's just kind of a tax planning tip, not necessarily specific to millennials, but that is helpful sometimes. So
it's sound advice, and I'd say oftentimes, especially with sole proprietors, it's their CPA that's telling them how much they ought to contribute each year.
Mm-hmm. Yes, absolutely. After everything shakes out and figure out how much self-employment income is actually taxable as well. So when we have these funds in these accounts, Dave, can you kind of speak to kind of what happens then, I guess, is maybe the most general way I can put that.
We have a strong belief here at JMF Capstone Wealth Management and conviction in how money ought to be invested. And it's because we subscribe to Nobel Prize winning, empirically tested science and academics. So what are some of those? I'll bore everybody. They'll all have a doctorate by the end of this, but it's efficient market hypothesis. Okay, so the market is the most efficient tool in setting pricing, and that's been proven, and it's robust. It's been proven in every market. Modern portfolio theory and the three-factor model, and basically what those two theories do is they prove where returns come from, how does the market actually work, where do these returns come from, and how is the whole portfolio working together, okay? It's not just taking risk for risk's sake. With every additional unit of risk, there needs to be a higher expected return. Otherwise, why would you take more risk? And there's a lot that goes into portfolio construction. You're looking at non-correlating asset classes. You need to understand how average returns work, and risk is measured by standard deviation. So you need to be honest with how much risk can you as an individual investor tolerate, because again, what's important is coming up with a plan that's going to work for you, not by enough more than you can chew, or not coming up with something that you can't stick to for the long term. And then going back and adjusting things because there's life events. You mentioned, you had children and daycare came up, and that was a necessary adjustment. Life events happen all throughout time, And with millennials, having kids is one of the common ones, right? But, one thing that's important for me to recognize, and I'm speaking strictly about the stock market, but as a CPA, I think you'd be a great resource to speak to some of the benefits potentially of rental real estate. I know that's something that comes up in conversation a lot, especially with folks our age.
Yeah. Well, and so, if you think about, okay, so we have the kind of traditional, I guess, accepted retirement plans that are very simple to get into because so many employers have them. You pick a percentage and you run with it, essentially. But of course, that's truly not the only way to save for retirement. And I'll of course speak a little bit to kind of to my personal retirement plan, or more specifically my husband's retirement plan. But so, if for some people, my husband included, something such as rental real estate is kind of an alternative investment that can be set up to, of course, grow in value for the timeline between now and when you're seeking to retire, when you plan to retire in the future. But it's also obviously a hard asset. A lot of people like to have something they can control and can potentially directly affect how smoothly that is going. So it's generally a stable appreciating asset. So that's something that we are hoping, as we build our rental portfolio, there are strategies you can, of course, enter into mortgages on those properties that are roughly approximate to the time that you expect to be retiring. So at that point, you would have paid off a rental property and would be able to have more cash flow from that property. And then in the meantime, you're benefiting from annual depreciation and all the other items that come with that rental property on an annual basis. So you don't necessarily get any specific retirement, benefits in the meantime, but the tax benefits of rental real estate, of course, are still hold in the time that you have it. So based on that, you would also, let's say, you get to retirement and you no longer are interested in managing that property, which of course is one thing that would be personality dependent, but at least at that point, you would have capital gains rates on the sale, so it would at least be a little bit, if we still have those capital gains rates at that time. If I had a crystal ball, you would still benefit from those lower rates, hopefully. So.
Yes, and one thing I'd just tack on to that is, I talked about financial planning, but when we do that, I'm getting away from millennials a little bit, because most people, when we meet them, say, okay, this is what I've got. What can we do? And it's important to get to know their life and what they're trying to accomplish. But there are plenty of folks out there who have retirement plans and rental real estate, and it can all be incorporated and should be incorporated and looked at together. And that is something that we absolutely do. So just know that you have options, and depending again on personality or what you want to take on, there are a lot of different ways to get there, but it's important that a good chunk of your income is being directed towards your future. That's the thing that's true about both of those. I know we wanted to kind of touch on some final reminders, which are basically like good housekeeping for anyone, but millennials as well. So go ahead, Katie.
Well, and I'll just add to what you were just saying, because I think that's the whole crux of the matter, isn't it? Is that you just need to know, you need to be thinking for the future. I'm sure everyone wants to retire. No one wants to have to continue working. So, once again, no one can predict what that's truly going to look like when we get there. But if you have a mindset of always working towards that, knowing what you have and knowing what you're doing to get there, then I think that's very valuable. And of course, where y'all come in as wealth advisors a lot of the time too. Of course, at this point, I guess full retirement age is 67 for Social Security. And I am curious, do y'all take into account Social Security, or would you take into account Social Security?
Absolutely.
Okay.
Absolutely. And, so we take into account Social Security, and what makes sense for each person has so many variables as far as when's the best time to take it. And generally, it's great to wait because you're getting a guaranteed return if you wait. But family longevity, family health history goes into that. The rest of your plan goes into that. And, again, the succinct answer is yes, we absolutely do incorporate Social Security, rental income, pension income, traditional retirement, whether it be IRAs or work plans or anything like that. And, one thing to think about that we didn't touch on, and this is, I'll call it millennial specific, since we're known for changing jobs, even though I don't think you ever have you, Katie?
Right, I have not.
You can think of your own personal IRA or Roth IRA as kind of a bucket if you are somebody that's changed jobs, and maybe it's just simply because you're ambitious to promote, right? And you have to do that to promote. General good housekeeping is clean up all of your old retirement plans and move them into your IRA or Roth IRA. What I see oftentimes is people forget about old accounts. They get hard to locate. People don't clean up the beneficiaries on those old accounts. So if you get married, it's important to make sure that your beneficiaries are correct and what you actually want them to be. Even if you have an estate plan or a will, the beneficiaries on your retirement accounts are going to supersede any plan that you have. It's going to go to who's listed as beneficiary. So that's something to think about. I'm going to kind of go down a list of good housekeeping, but if we're having children, we talked about, your kids going into daycare, and I've got a young kid as well. At a minimum, it's really inexpensive to get term life insurance, get it till the kids are out of high school. But just if, in a worst case event, something were to happen, at least that financial burden's lifted from the family. My mom passed away when I was younger, and they did not do that. And that's part of why I take planning very seriously. So that's something.
And along the same lines, we wanted to mention short-term disability insurance just because, when we're younger, it is much more likely that you're going to become disabled versus actually dying. And so, if you have that, just similar to the term life insurance, if something were to happen to you, most of the time, or maybe not most of the time, but frequently an employer will have, at least a small amount of short-term disability insurance included in their employee benefits. But just know what that is if you do have that. And if you do not have that through your employer, then consider getting that as well, just because obviously there are, if you were to die, the ongoing expenses there are very different than if you were to become disabled.
Absolutely.
So, for all these things, obviously, I think the most important piece of all this is that you need to have a team of trusted advisors around you, professionals that can help kind of guide you through each of these scenarios, that know your goals, your personal goals, what your financial goals are, know your family, and can help get you through that, to be prepared for whatever may come. So I think that's probably the most important thing to know, because everything that Dave does, of course, works in conjunction with everything that CPAs do, that I do. So you need that team in place. That way you can be prepared.
Absolutely. And these can be positive life events too.
Yes.
So whether you're, selling a business, or, let's say you held property that's got a really low cost basis and you want to offload it, before doing anything, because that might be a one-time event for you. Before doing anything, seek out the help of a trusted professional that actually deals with these instances every day, because they'll help you plan for it and end up with a best case scenario for the particular situation.
So when it comes to millennial retirement planning, I think the overarching message here is that you do need to plan for retirement.
That's right. Well said.
However it is that you want to get there, however best fits in your life, whatever it is, just have a plan in place, a loose plan. Be ready to pivot as life changes, and we think you'll get there. So,
and the sooner you get started, the easier it will be to get there. So I know, that's sage advice from somebody that's smack dab in the middle of what's considered a millennial, but get started young. It's never going to get easier.
Absolutely. Well, thanks for joining us today on the JMF Advisors Show. Hopefully this was a helpful discussion, and please reach out to any of us at JMF if there's anything we can help you with specifically, or answer any other questions.
That's right, and I'll sound like an elder millennial, but what do they say? Smash the like button, like and subscribe.
Yes.
All right.
If you would like us to help your business or would like to suggest additional podcast topics, simply send an email to info@jmf.com.
And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps.